Thank you very much, and a warm welcome this morning. On behalf of my colleagues, those waiting on us, maybe if they can suspend the service for a few minutes. As a catering team can suspend the service for a few minutes, and we'll be able to start. Bridget, if we could really suspend, that would be very kind. Kindly, those serving tea, if we could really hold on for a few minutes, we would really appreciate. Thank you very much, Chair, for your kindness. Thank you very much. I deeply appreciate it. This morning, as usual, we'll go through the numbers. What is called the equity organization culture. So while, as we said, we will not have a number assigned to it, it's good to appreciate that the numbers we see are produced within a context of an organization culture.
Equity.
So I want to thank Alex and the team in my office for this morning teaming with me to make the presentation. The four stanzas speaks loudly on what drives us and our convictions, and you can see the inspiration among the staff is very strong. But let's go to the numbers and see where we are. And we'll start with a review of the macroeconomic environment. And since we are a group operating across the Eastern Africa, we'll have a review of the environment in the Eastern Africa. And we will start maybe with Uganda. And looking at Uganda, we see very positive sentiments and a very positive outlook with expectations that GDP will climb up to 5.9, up from 4.8 in 2017 in terms of growth rate. We see inflation at an all-time low of 1.7, and we see the CBR rate trending down for the last 2 years. So we can then anticipate that the macroeconomic environment 2018 will be enabling and generally stable, other than for the non-performing late loans across the banking industry, which have climbed all the way to 10%. When we look at Rwanda, we see a country estimated to grow GDP growth rate at 7.1, all the way from 6.1, and with inflation at about 5%. Tanzania growing at 6.8. And if we look at just those three countries, we're really talking about an estimated GDP growth rate of nearly 7%. And that compares very favorably to sub-Saharan African numbers, which are much far below that. And even DRC, which had suffered for the last 2 years, the depression because of commodity prices, we see economic growth now forecast at 3.3, driven significantly by improving output as a result of sharp price increases in commodities, copper and cobalt. We see, if you look at the trend in inflation, we see almost coupled rates across the region. And we see that the macroeconomic environment in the region is almost the same. When we look at interest rates, they're going at this, almost at the same direction. Almost a single curve can represent the interest rates, the inflation within the same with interest rates. We are seeing interest rates, whether it's in Rwanda, whether it's in Uganda, showing the same trend. But we have singled Kenya out because Kenya is the biggest economy in the region and is where 80% of our business is. And when we look closely at Kenya, we see now inflation contained, even below target at 3.7, and inflation expected to remain low because of improved weather conditions, and food most likely not being a major factor going forward. We look at foreign exchange, and we see a significant phenomenon of improving and strengthening of the Kenya shilling against the US dollar, and seeing an enhancement of nearly 3%. And that again makes our imports much cheaper by the same. Then we ask ourselves, how sustainable is this? And then we look at the foreign reserves, and we see we still have very healthy reserves. Yes, they can be threatened by rising crude oil prices, but for the time being, they are being driven heavily by diaspora remittances, tourism, growing numbers, and we expect healthy exchange rate, hopefully for the 2018. When you look at within the region, we see Kenya significantly strengthening the currency vis-a-vis the other regional currencies. And that strengthening sometimes helps, particularly for those investing outside the country. Then you see that the investments hold in terms of value. We look at interest rates in Kenya, and again, because of interest capping, they are predictably stable throughout the year. There is significant talk of revisiting the interest capping, promise of removal of the same in course of the year, and that hopefully will have some movement in the interest rates, but timing is everybody's guess. Interbank rates, again, significantly oscillating between 4 and 11%. Again, when you look at that huge variation in interbank rates vis-a-vis very stable interest rates, whether in government stock or the capped interest rates or the central bank rate. That reflects the state of the banking industry. And the full impact of interest capping is reflected with the private sector lending, even with the consumer lending around December still is subdued when it comes to January. And so we are stuck with the private sector not receiving sufficient growth. And a growth rate of 1.8 cannot sustain an anticipated economic growth rate of 5.5. Something must give way, and I'm glad it is interest capping that is giving way to the flow of credit to the private sector so as to sustain GDP growth rate. Of great concern is debt to GDP ratio, yes, high, and we can have seen the impact. The government has responded to these, and if you look over the last 4 years, we have moved from a 40% allocation of budgetary allocation to development projects, I think, to this year 19%. So again, the impact may slow investment by government on infrastructure, but we can sweat the current infrastructure and still sustain an upward growth rate. An economic outlook on Kenya, to a great extent, shows inflation is likely to remain within the range of 5%. Foreign exchange rate anticipated to remain stable given political stability that we seem to be enjoying after the protracted elections as a result of strong capital flows, diaspora remittances, and increasing tourism. And when we look at interest rates, there seems to be a commitment on amending the interest rate cap, and that, of course, will reflect the trend. But I expect that interest rates, even if there will be movement, it will be fairly stable throughout 2018. And of course, GDP is anticipated to grow at 5.5, up from 4.8. So when we look at that and then put it in context, particularly in Kenya, of generally the East African region, where none of the countries is having elections for the next 3 years, we anticipate a very robust environment for business, because politics is a big factor in our considerations of development. When you look at the financial markets, as we have seen, microeconomic environment looks stable, so we expect long-term investors to now start having flows, because we have another 4 years to go before the next elections. But more importantly is the continental agenda of the African Union. And we see a lot of focus on the continental free trade area, free movement of persons, focus on accelerating manufacturing and industrialization, joint venture, development of infrastructure, and value addition and processing of natural resources within the continent. All these would bring significant opportunities. So we have a very positive outlook from that perspective of great opportunities, and we expect 2018 to be a very strong year. Given that the interest capping is still in place, we're still consistently pursuing the model we developed last year, but one that differentiated slightly from the traditional intermediation model, and we now focused on quality of earnings, particularly on non-funded income, looking at efficiency of Treasury, because investment in Treasury stock is having a higher yield once risk adjusted than lending. We are looking at the region and seeing this is a whole region growing at approximately 6 to 7%. And so we deepen our presence and really grow the outfit within that region. We are looking at the balance sheet, given the interest capping, lifting the interest capping, and saying, will the balance sheet be agile enough? Will it be flexible enough to take opportunities that might arise? And of course, we are in an era of innovation, a lot of an innovation culture being enhanced and read with the digitization. And of course, eventually, it's all about profit margins, which is not about revenue alone. It's also about cost optimization and containment while holding asset quality as the real definition of what a good bank is all about. And acknowledging that we operate on public license, and hence always thinking about the impact we have in our society, particularly in terms of social investment and development of brand in concurrence with the communities in which we operate. So if we look at each area, because it's only looking at these areas that we fully appreciate the bank, we see their own interest income. The first quarter, we're still a couple of billion shillings below. We are almost now reaching 9 billion, up from 8 billion last year. But we still have another 2 billion shillings to go to catch up with where we were on the first quarter of 2016. But we see when it comes to total interest income, we are almost catching up. 12.9 billion and 12.7 billion. So the loss of 2 billion shillings in interest income is now almost compensated, and it's compensated by non-funded income, which has rose from 5.2 billion to 6.7 billion. And when you look at total income, ultimately, 2018 is now much better than 2016 before the interest capping. Our total income has climbed up. When you combine interest income with non-funded income, our total income has climbed to 16.5 billion, up from 15.6, 900 million shillings better position. And basically that then shows how quickly the bank has adjusted, how the strategy we adopted, how agile the bank is, and how powerful the bank is in execution once it formulates a strategy. And most likely, I want to speak of a very successful and impactful strategy, well executed, and within a year, helps the bank to bounce back on its growth path. We look at this other income, which is now contributing 42%, and we see how diversified those streams of income are and how well they are growing. And we see trade finance growing at 32%, merchant banking by 23%, mobile banking commissions by 75%, boat trading 152%, and SWIFT and RTGS income by 45%, while diaspora remittances income has grown up by 183. Again, the resilience of the bank, how innovative the bank can be, how responsive the bank is, and its power of execution of strategy within a very short period, and that then would almost tell. Then we look at Treasury, because Treasury is the alternate, or public debt is the alternate to private sector. We saw private sector growing at 1.5, and we see that the bank has significantly grown its public sector lending from 113 billion of this first quarter of 2017 all the way to 150 billion shillings, reflecting growth on the liability side. That's significant growth on the customers' deposits. And we see Treasury income growing again significantly from 17.8 billion all the way to 19.4 billion. And that is where the compensation has come from. And we see the mix and the widening mix of Treasury incomes, again, showing stability. And when we look at the yields on Treasury bills, it has come down from 11.1 to 10.7. But if you look clearly, you see the mark-to-market gain has increased from negative 1 billion to positive 700 million shillings. Quite a significant value because of an early decision to invest in Treasury bonds. So as interest rates in Treasury bills come down, then the inverse in terms of capital gains is happening, and we see it very well positioned in terms of Treasury operations. And I want to applaud James Motuko and his team. We saw Treasury last year. But two, Treasury contributed only 7% of the total income. Last year, but one, it generated 15%, and last year, it generated 27%. And we have an ambition of pushing this all the way to 35% of the total income this year. So Treasury operations have become very, very central because of the environment that we are operating, efficiency. And we see more of foreign currency trading, Forex flows, because of our success in diaspora remittances, will drive Treasury significantly. And we'll see a mix, a good mix of Forex income and Treasury bond income. The third focus has been on geographical and business diversification. And we see very significant success where our subsidiaries year on year have grown their incomes by 65% compared with Equity Bank Kenya, which has only grown its profit after tax by 14%. So it's almost growing about 5 times. The subsidiaries are growing 5 times faster than the mother core business in Kenya. And that really speaks to the microeconomic environment and the GDP growth rates we saw in the region. So Uganda growing at 28%, DRC at 78%, Rwanda at 58%, Tanzania 68%, even South Sudan, which pushed down to maintenance level, nearly 300%, and Equitel 204%, and the investment bank after aligning it almost at 500%. So essentially we see the contribution of the subsidiaries to the total group profit jumping from 14% to 19%. And as a result, we have decided to focus, to give a huge focus on the subsidiaries. And we saw the board appointing Mele Wamai as an executive director in charge of these subsidiaries. We have seen the opportunity, we have seen what, if nursed well, these subsidiaries can be a major contribution. But we're also very excited that their deposits contribution for the group have moved from 20 to 24%. The loan book also from 20 to 24%. Very, very balanced growth. And assets from 22 to 25%. So we really see subsidiaries that are really modeled, and it's almost the question we have always been asked, can you replicate yourself in the region? Well, we see exactly a perfect replication of Equity Bank, the model growing in a very balanced way in every respect. We have talked about the agility of the balance sheet, and we see a very agile balance sheet, a very strong balance sheet, growing at 7%, but heavily driven by customer deposits, which have grown by 9%. At a time, the banking industry is stagnating. So when you grow at 9% in an environment where the banking industry has stagnated, it speaks of the confidence that the customers have in the bank. All it speaks about the brand strength, the strength the brand enjoys in the marketplace. And we hope we can continue to consolidate the bank, our market share within the region. And of course, as we have seen, when it comes to deployment of the mobilized funds, we see public sector investment. It's receiving disproportionate, higher ratio. While loans grow at 4%, government securities have grown by 33%. And in Kenya, it's even almost the same picture. And then we look at the strength of the bank in terms of liquidity, and we see how ready the bank is for any opportunities, particularly with the removal of interest capping. The bank can significantly grow its. At the moment, we have a deposit loan ratio of 68%, and we optimize profitability at approximately 88%. So we can grow the loan book significantly. The funds are available, they are short-term. We have a bucket of 10 billion shillings of Treasury bonds maturing every month, so there is no constraint of transforming this public debt into private sector debt if interest rates removed. When we talk about a culture of innovation and digitization, I think the picture couldn't be clearer. We see last year we rolled out internet banking using EasyNet for personal internet, and for corporate banks, EasyBiz. And we have seen that within the first few months, we are seeing visibility of internet banking. But it's the mobile banking which has really taken off in a very big way. We see branches for the first quarter have done 4.5 million transactions, while the mobile platforms, Equitel and Easy App, have done 108 million transactions. So when you talk about fold, you are talking about 30 times in terms of the number of transactions. And that is really speaks about digitization. You can only do mobile banking, internet banking, if the platforms, if the processes, the products and services are digitized. And we see the bridges to digital money and physical cash, what we talked about the agents. Because it's the agents that convert cash into digital money, and vice versa, playing a very significant role, but very far from electronic money. So essentially we can say the country is in motion of transition. And we hope as retail trade get digitized, then hopefully we'll see the country becoming cash-light and becoming very, very efficient. But we see our operations becoming heavily. The areas of the channels, as we see, we can see at transaction level, we have moved from the fixed cost platforms to the self-service and third-party infrastructure in terms of mobile and internet banking and agency banking. And that trend, we've seen it consistently. And this digitization has really transformed the bank. This is the third year we are now talking about digitization, but it has really moved to great length. We also talked about digitization is not just about processes. We are able to digitize because we have developed fintech capabilities, and we see application of fintech capabilities, particularly in merchant banking. And in merchant banking, we have seen in the next slide, Alex, we see the development of EasyPay as an innovative POS that allows convergence of payments from mobile wallets, from cards, making it seamless, master POS that can acquire transaction from all globally issued cards, really driving that business. And we see a growth rate of 36%, with the first quarter processing 17 billion shillings of merchant banking volume, up from 12 billion shillings, and commissions increasing by 24%. That is the power of fintech capabilities as we start applying them on one product after the other. And we can see the number of outlets growing significantly. And if you put the 30,000 EasyPay merchants, we are now talking about 46,000 merchants out there helping to digitize retail payments. But the greatest success of fintech innovations is clearly visible in diaspora remittances. And we see those diaspora remittances almost growing sixfold from a volume of 3 billion shillings last year to 18 billion shillings this quarter. And again, this speaks not just of the 183% growth in commissions, but speaks a lot about what is happening in Treasury, because these 18 billion shillings have come in foreign currency and paid out in local currency, and that foreign currency becomes available for forex trading in Treasury, supporting our SMEs that are importing, supporting those who are paying school fees outside the country. And we can see Equity Group now becoming a major actor in Treasury and forex transactions, becoming very attractive for SMEs that are in the import business and multinationals that constantly require funds. And that opening again explains how diverse the bank has become and how sustainable the non-funded income growth is. The fintech innovations in digitization is where we are seeing really phenomenal change. And for clarity purposes, we have compared 2017 and 2018. And we can see 2017, the dominant channel for the digitized transactions was Equitel. But 2018 or late 2017, we innovated the mobile app so as to set ourselves free, to give customers freedom to access us using any telecom channel or any mobile company they wish to. And suddenly we see Equitel reduced to 43%. Not that the volume has declined, but because the mobile apps grow from 12% to 35% of all the volume of transactions. We are very excited about this phenomenon because Equitel is centric to our customers, principally feature phone holders, but the app is very appropriate for smartphones and gives the clients the freedom. And we have seen that freedom. As you can see, branches which last year processed 4% of all transactions, this year they have just been reduced to processing 3% of all transactions. You could imagine 4 years ago, branches processed all transactions. And suddenly now, branches are only contributing to processing 3% of all transactions. That is the power of digitization. What does this slide speak to? This slide now speaks to customers empowered with freedom of choice and control. They choose, they have the freedom, they choose, and they have control. And that really ability to empower them in such a strong way has been rewarded significantly in loyalty. And we have seen in just 1 year the number of customers growing by 1.1 million customers, simply because of the attractiveness of convenience. What the digital channels have done is to remove banking being the issue of going to a branch to what you do on the devices. If it is internet, maybe on your computer, if it is mobile, on your phone, and that is what banking is all about. In the process, geography has become irrelevant. It's compressed. It doesn't matter where you are. Time has become compressed. It doesn't matter what time. Banking has become 24-hour service, and at whatever time you wish to do. And we can see even agency, the master driver of digitization, converting hard currency or coins and notes into digital money is reducing from 14% to contribute to processing only 12%, suggesting that most people are now keeping their money in digital form. That's basically what it means. The declining activity at the agency level means that people have accepted digital currency, and they don't need to convert. They can pay and they can receive on digital currency level. I think this picture becomes complete when we look at the next slide and see that digital transactions, while they have taken 97% of all the transactions and branches reduced to 3% of the transaction, we see in terms of value, branches are still handling 46%. What does it mean? There was a lot of fear in the past, and I couldn't explain myself what will happen to the branches. We see what has happened to the branches. The branches have become centers of serving SMEs and corporates. They have become centers of value addition banking. They have become centers of wealth management, advisory services. We have been able to enhance customer experience through better relationship management. So basically, that's already what has happened. The branches now are doing high-value banking, while transactions have been digitized. So it was as simple as that. We didn't need to remove the branches. We just needed to shape the branches. We didn't need to release the staff. We just needed to retrain the staff to do a different kind of banking. What have we created? We have created 2 banks now, an SME corporate bank and a transaction bank. The transaction bank is virtual because it is digitized, and the SME corporate bank is still at the branches dealing with high-value transactions. This year, we have embarked on digitizing SME banking, and hopefully by the end of the year, Philip, we shall also embark on digitizing corporate origination. And again, with EasyBiz, which is being fronted by our last year's young banker of the year, Gaki, maybe you could raise your hand. She's the one championing corporate internet banking, cash and liquidity management. We would see the cash transactions of also corporates move away from the bank. So really cash management will be virtualized, both for the individual, for the SMEs and the corporates. They can manage it themselves from their offices. And so it's more value addition, it's relationship management, it's acquiring, it's sales and servicing, and brand enhancement that will be done at the branches. We have not only been successful in digitizing cash, but the next slide shows that we have also been able to digitize the bulk of our loan process. We now have, to date, 92% of all loan transactions are being processed virtually. It's because the process has been digitized. But we still have, as we speak in terms of value, 77% in terms of value, the loans being processed in the branches. And that's what we were saying. 92% of all the loans are outside the branches. The branches are left with only 8% of the loans in numbers, but those 8% loans in numbers contribute 77% of the volume. And that's why we were saying branches are serving SMEs and corporates that are borrowing big loans. And that is why we talked it's value addition. What have we done? We have enhanced the jobs of our staff. It's no longer the simple loans. It's now complex analysis of loans. And we have significantly enriched the jobs of our staff. And we're very, very proud of this really phenomenon of enriching jobs for our staff. But now we all can guess what this will do to cost-income ratio and the cost structure, the ability to optimize on cost. And so if we move on to look at the agency network. The agency network over the last 7 years have grown from 0 to processing an average of 40 billion shillings monthly on cash deposits and processing approximately 12 billion shillings with withdrawals. So we can talk of 55 to 60 billion shillings being processed through the agents. And on a daily basis, the agents sharing approximately 5 million shillings in commissions. And this to us is the biggest opportunity for shared prosperity. Instead of us serving in our branches, we have outsourced transaction processing to our agents, and we share by training them, they become more professional business people. By giving very professional business, they up their skills, but more importantly, enhance their business models because of the human traffic that we bring through their door as our customers seek their services. We have approximately 300,000 transactions being done by the agents. Equitel is doing about 800,000 transactions per day, and the Easy app is doing about 600,000 transactions per day, and branches have been reduced to only doing 55,000 transactions in a day. It's the lowest level of delivery channel, but highest value. And that's what we have said. Jobs have been unleashed. Jobs have been enhanced in terms of the capabilities that they require. All this process of digitization is having significant impact on efficiencies and optimization. And we see the slowest growth we have witnessed in the past in terms of cost and expenses. And we'll see that this plays very heavily. If we look at cost-income ratio, despite the laws we had to go through of interest income, we've been able to reduce our cost-income ratio year on year from 49.4 to 47.2. Reducing cost-income ratios with 200 basis points within a year of a bank of our size, it could tell you how the profit margin jaws behaving. They are widening, and they're widening from both sides. Cost compression and revenue enhancement. And of course, we'll see the impact of that. So we see interest earnings. When you look at the yield on interest earning assets, they remain very strong. Costs have remained contained, and hence net interest margin also remains fairly stable during the period. But the emphasis, as we said earlier, one area that we are very proud of as a bank, and this is again speaks of our execution capability, is asset quality. A good bank is defined by the quality of its loan book. And while the industry, as we speak, is averaging 12% NPLs, we've been able to, an increase of nearly 200 basis points from December. We're still, we have been able to maintain our NPLs at 6.3. And since we had well provided for these NPLs, you'll see that quarter on quarter, we did need to enhance our provisions. So you'll see a significant reduction in provisions. Why? Because NPLs have remained stable, and those NPLs had been well provided for. So the provisions we have had to make, as we can see, the coverage of NPLs have increased from 69%. One slide, at group level, at Kenya level, it has enhanced from 64.9 to 105. That difference there is not an NPL, P&L provision. That is the IFRS provision. We have asked ourselves, in the portfolio we are holding of 220 billion in Kenya, what is the probability of loss? And we have taken into account that and done as an IFRS adjustment. And since that adjustment is future loss, when we put it in the total provisions, that is why coverage is above 100%, because it is probability of default. The loans haven't defaulted, but we have estimated during the lifetime. And we shall go through. If you look at the country level, again, you see Kenya is the one that is, Alex, still the same slide. I'm looking at the NPL distribution per country. We see Kenya there per sector because of transparency. And we can see the sector that is giving us challenges is micro enterprises. And that is why you'll find we are inclined to public debt. Why? Because we are an inclusive bank. The bulk of our customers are micro enterprises, but their default rate is already known, is 15%, and you are expected to lend to them at a weighted average interest rate of 11%. It's not practical, it's not possible, because you then make loss before you have disbursed the loan, because the loss ratio is higher than the risk. You are not pricing that risk. You are only pricing a maximum risk of 14%, and the risk is 15%. So at the gross level, it's a loss, and that is why equity is having excess liquidity, because we can't be able to let that sector. As you can see, because the other countries have that huge problem, they have a better loan book than Kenya, by far, except Sudan, which we know is a fairly fragile state. We are proud of what Rwanda has done, 2.4, and we are seeing that trend of enhancement. When we look at the group level, the ratios are even better. Next slide, Alex. And the coverage moves all the way to 110%. Why? Because the loan book is even better at the group level. There is improvement. As at December, our NPLs were at 6.7, and they have come down to 6.6, against an industry average, as we said, of approximately 12%. And that, again, is the distribution. We see Kenya is the one that holds the micro enterprises, and that's where the challenge is. Agriculture, because of the drought, and essentially that's, if we look at the application, we said we'll give you the numbers during this quarter, the application of IFRS 9. There we are. Total loan book as at December was 265 billion, and we have asked ourselves, what is the potential loss? We have used a lot of what one would call big data, analysis of the past, the track record, the probability, and we can see the probability of default, future default in Kenya is at approximately 4%. At the group level, 3.7. The other countries sounds much better than Kenya. It doesn't mean we'll lose the 4%, but we have become pretty prudent because it's a one-off adjustment you can do based on the loan book you are carrying today. For any loan that we disburse today, we are taking a provision on the date of disbursement based on probability. You no longer wait for a loan to go bad. At disbursement, you do assessment. For the existing loans, we had to do a one-off assessment and book it in our books. That booking is what is being called IFRS 9. And the total provision we have put in the books for future potential loss is 9.8 billion shillings, distributed, as we can see, and resulting into coverage. If we look at countries that have very good loans, like Rwanda, it has a coverage of 143. Kenya has a coverage of 110, and on at gross level. So resulting into a coverage of 105 at the group level. So essentially for the investors, or the potential losses on the existing book has been taken into account. Barring extraordinary events, potential loss has been taken. So what will we see? We'll see increasingly less provisions in the P&Ls going forward because you have recognized future potential losses in advance and adjusted accordingly. This adjustment of 9.8 is not going through the P&L. This adjustment of 9.8 is going through retained earnings. It's a hit on capital, and that is why everybody has been talking, what will be the effect of IFRS 9 provisions on capital? And if we turn to the next page, then we see, given the central bank ratio requirements, saying we adjust over 5 years, equity is still far above the minimum ratio requirement of 14.5, whereas at the group level, we are at 20, at Kenya level, we are at 16. But even if you forego the accommodation by central bank, and we look up there, the adjustment is only 1.5% and 1.6% at group and in Kenya, and the group and Kenya still complies with the minimum capital ratios. So there is no impairment, there is no capital requirement, and as we know, it's a fairly profitable bank, so it will build the reserves pretty fast. So if we move on, we then ask ourselves, and this is the most important area for me, building a brand. And we're building a brand through not just performance. It's good to have a powerful banking brand that has very high asset qualities, that is very innovative, very efficient in services. But for me, it matters what the public thinks about equity. And we have tried to influence what the public thinks about equity. And we have sought partnerships of our friends and like-minded people. And over the last 5 years, we have invested $334 million, or 35 billion Kenya shillings, in these projects. Wings to Fly have taken 55% of all that money. We have 15, we'll see the numbers. Leadership program, the international scholarships, which we have almost now nearly 500 kids in global universities have taken 34%. Agriculture has taken 1% because most of it is done through the branches, so it has no financial literacy, or what we call finca training, 6%. Energy and health, Equiafia, we have seen the investment, they have taken each 3%. But the size of the programs is in the next slide. So that is the impact of $334 million being invested. We are seeing 1 million trees planted. We have seen 40,000 clean energy products distributed to our customers. We have seen Equity Leadership Program sponsor 10,641 kids in our universities. We have seen 4,000 of them admitted to intern with the bank, and 461 flying out of the country to seek higher learning. And we have seen 15,168 needy, bright kids getting an opportunity. And what really we are very proud of is that 86% of all those kids have made it to university. And for us, that speaks volumes. But we are also excited to see 1.5 million Kenyans going through a 13-week financial literacy, while about 37,000 of them have gone through a prolonged entrepreneurship. And of course, shared prosperity. We're very excited to see 36,000 agents and 13,000 merchants being part of our distribution infrastructure, outsourcing business to them, sharing the prosperity of a great bank. And we're also excited, 283 landlords are housing us, and we have a relationship of a tenant landlord, again, sharing the prosperity that the bank is creating within the community. What have we, in the process, created? We've created a very powerful, iconic social brand. And the attractiveness of equity is not purely about banking. It's about the emotional bond it forms with its client. It's the caring effect that customers take. So we can talk about our numbers. Let's see what others think about us. Do they validate what we think about ourselves? And we see this is more about our loan book, the quality of the bank, and we see Moody's maintaining our rating on the same rating as the sovereign rating. It can't get any better. That's the maximum it can be. So whether you buy a treasury bond or you take a fixed deposit with equity, the risk is the same. But the good thing is equity is able to pay you a little bit more than the Kenya government on your deposit. So I invite you to maximize on your return. The same with the global credit rating. The ranking on top of top 1,000 banks, we take pride. We are the leading bank in Africa in terms of returns. We are the best SME bank. What Africa really needs most is an SME bank, and that is who we are. In terms of regional ratings, we move from global to regional rating. We take pride that for the last 10 years, we have maintained year in, year out, the super brand status. In terms of East African Business Council awards, we are voted the best company in East Africa, the best East African company, and the chairman's award of the overall best regional company came to Equity. So it's the same endorsement. The banker this year, 2018, best commercial bank in East Africa, best commercial bank in Kenya, and most innovative bank. So again, the same innovations we were talking about. People can see product where the bank rates as the best digital offering. And we are glad that the leadership of the bank, both the old and the young, because remains with the bank. But 2018 Kenyan National Banking Awards, this is where the rubber meets the road. It's the market that we are best at. Brad, overall, best bank in Kenya, best tier 1 bank, best bank in sustainable corporate social response, most customer-centric bank, the bank with the lowest charges. It's a very good combination. Best bank, but also the lowest charges. So you can enjoy the services of the best bank while paying the lowest charges. You look at franchise, and again, that is the most important thing. Nobody is being left behind. If you are an SME, you are banking with the best bank. If you are a retail customer, you are banking with the best bank. If you are banking with the agency, you are banking with the best agency bank. If you are a mobile customer, you are banking with the best mobile franchise. If you are on digital banking, you are banking with the best franchise in Kenya. And best commercial bank in microfinance if you are a microfinance customer. And the best bank in corporate banking, runners up. To us, that is what financial inclusion is. Best of breed in all segments. When we do customer segmentation, there is no customer we prefer. We are best. We do it the same way for all segments. You treat people the same way, give them the best. And when you look at the product level, internet banking, asset finance, product marketing, product innovation, mortgage finance, trade finance, livestock, agriculture, you're banking with Equity. Even the judges themselves, they think Equity is the best in product innovation because it has gone beyond banking to address health issues of its clients with Equity Afya. And leadership, I'm very excited. Where is Daniel Kashau, treasurer? Oh, very good. That is youngest banker of the year. And I'm glad I've retained the title of, so for 2 consecutive years, Equity has produced the CEO of the year and the young banker. And we are very excited. A man, start again, Gashau, and a lady, Kaki, 2 bankers, 2 consecutive years. An employer who offers equal opportunities irrespective of gender. And while the present looks good, we assure you the future will even be better because of the investment. Thank you very much. So, and you can have these all awards, and you can see how excited we are. We entered 24 categories and got 23 awards, 18 of them being number 1, 3 of them being number 2, and 1 number 3. And we're very proud of our staff. Gerard, you can start, leads us in operations, so he leads the team. But you can have all these awards, trophies, very good. But what does the market, is the market willing to pay a premium? And this is the most exciting slide for us, that the market appreciates the differentiation. The market is willing to pay a premium and is almost paying 50 billion shillings more for a bank that is not the largest, is not the tallest, is not the fastest. It's for us this speaks volumes, that the market is willing to go back to the wallet and tell us, you are a differentiated blood, a differentiated bank, we are willing to pay a premium for your value. This speaks about the future. It's not about today. They are investing for future streams of dividends. They are investing because Gashau can be trusted to drive Treasury. Gaki can be trusted to drive corporate. But what does this mean in numbers? So when we look at the numbers, we see balance sheet growing by 7%. But that growth of 7%, as you can see, is driven primarily by customers' deposits that has grown by 9% at a time the market has stagnated. But again, we can see the loan book grows with 4% on the bulk of, because of the challenges of leading to our predominant sector of micro clients, the small and medium enterprises, where risk is higher than the risk pricing that is allowed by interest capping. And as a result, the beneficiary is the public sector. And one can say the public sector is crowding out the private sector. That is not how to grow an economy. And that is why we have always been convinced that ultimately this picture will be clear and the interest capping will be removed. And that really speaks what it's all about. And we see shareholders' funds continue to grow despite the 9.8 billion shillings being netted off of IFRS provision being netted off against the retained earnings. We still grew retained earnings despite that aspect. When it comes to what matters most, we see profit year on year growing by 22%. And as we can see, we see a better year than before. We see now interest income is no longer declining. We've been able to override the impact of interest capping, and we see net interest income growing at the same rate of 10%, non-funded at 6%, total interest income growing at 9%. And we see what we talked about, the impact of digitization. Loan loss provision, because we have taken upfront future provisions. We no longer, the loan book has remained the same in quality, improved slightly at the group. So you see reduction in provision, significant, and you see operating expenses remaining almost at the same level with inflation. And that gives us total operating costs or total cost declining by 1%. This is what we are saying, a widening jaw. Incomes are growing by 9% and costs are declining by 1%. The profit margin jaw is widening, resulting in a profit after tax of 22%. And this, when you translate this in ratios, you start seeing return on equity. Kenya now is bouncing back to 31%, at the group level at 27%. And return on asset, almost the group being at the same level with Kenya, 4.6 and 4.5. And this for me speaks volume about the projection of the future. If we move to the next slide and try to look at details, we see almost return on equity. Uganda is catching up with Kenya. It's 31 and 29%. But we see Rwanda, Tanzania, and DRC breathing very closely with 18%. But the picture becomes complete when you look at the cost-income ratio. Kenya is 42, and we have 3 bank subsidiaries, Uganda, Rwanda, Tanzania, that can reduce their cost-income ratio by maybe 500 basis points by the end of this year. While we see DRC, we acquired DRC 2 years ago with a cost-income ratio of 88. It has come down to 68. We expect DLC to close this year with a cost-income ratio of approximately 60. And that's what we are saying. The jaw is widening and the profit margin of equity is significantly enhanced. The cost-income ratio. So this to us is the table that tells us the health of each subsidiary, the direction, and if we really are able to capture the spirit of this, you can do projection. Equity can grow much faster because the growth is not coming from the core business of Kenya. The next wave of growth will be coming from these subsidiaries that are in their 5th year of operations, and you can expect them as they scale up. Rwanda, we bought, DLC, we bought it 2 years ago when it was number 7 largest bank in DLC. We brought that down to number 4 in 2 years. Rwanda, we are number 3. I think Uganda, we are now down to number 4. And we can see that significant improvement as the benefits of digitization are replicated in the subsidiaries. And looking at the capital ratios and the yields, they are all there for the group and for the core business, which is in Kenya, or what one would call the motherboard of all these subsidiaries. Lastly is our outlook. We haven't changed the outlook, but there seems to be an opportunity for enhancing it. Why? Because if you net off, if you take into account the 9.8 billion, call it 10 billion of future provisions that have been netted off against loans, the loans had grown by 9%. But because they are netted off that provision, IFRS 9 provision, potential loss of the future on the 265 billion, then that has come down. If you look at deposit, 9%, so we don't have a problem of intermediation. Deposits are growing faster than loans. We look at interest margin, we expected 8.5, minimum we are 8.4, non-funded we expected 42, we are 41, cost-income ratio, that's where we have overperformed. We expected 48, we are already at 47. We think we can move lower than that. Return on equity, we expected maximum 25, we are already at 27. There's an opportunity of enhancing the outlook there. Return on asset, we expected a maximum of 4.7, we are already there. We can enhance. Cost of risk, we expected 0.8, at 0.5. We don't anticipate any growth in cost of risk because, as we have said, we have used IFRS 9 to take the risk of the existing loan book. So this can continue to be much lower than we had anticipated. And NPLs, we had expected a maximum of 5.5. We believe we'll maintain that ratio. We have really to work very hard to deliver on that. Subsidiaries, we expected them to deliver minimum 25. They have already delivered, so in terms of total asset, and profit and loss, minimum of 20, and they have already delivered 19. But we want to maintain this outlook for one more quarter, but any adjustment will be done at half a year. Just in 1.5 months, we should be able to review the outlook. We'll be certain how the numbers are most likely to look like at the end of the year. I want to thank you most sincerely for coming up for today's briefing. It has been long, but we needed really to demonstrate this is completely differentiated from any other bank in the market. The strategy is different, the model is different, execution capability is different, and and innovations are a major driver of the bank. So those are the 4 takeaways. A serial innovator reaping big from innovations, digitization widening the profit margin jaws significantly and can be expected to do that. A customer-centric model that allows the bank to continue to grow because of customer confidence. The brand is superior. Delivery capabilities that allows every segment of the bank or every franchise of the bank to be the best in the market, and hence attracting those who want to be in the best bank. And a very fragile, a very agile balance sheet that can easily do a U-turn in the middle of a load. Equity doesn't need to go to the next roundabout. If it sees the need to reverse, it will be able to do a U-turn because of a 56% liquidity and a very execution-driven leadership. I think I will stop there and thank you once again, but maybe we could take a couple of questions if there are any clarifications. All comments, they don't have to be questions. All of you are stakeholders. You can contribute to the presentation. Thank you. Thank you. Thank you very much.